In the high-stakes world of finance, fortunes can be built in silence, then obliterated in the blink of an eye. In 2021, Archegos Capital, a little-known family office run by former hedge fund titan Bill Hwang, became the epicenter of one of the biggest financial collapses in modern history. Armed with hidden leverage and risky bets, Archegos quietly controlled over $100 billion in stock exposure, manipulating the market in plain sight. But when one stock stumbled, the entire house of cards came crashing down, wiping out $20 billion in just days, and leaving some of Wall Street's most powerful banks reeling. This wasn't just a bad trade or a run of bad luck. It was a masterclass in unchecked greed, regulatory blind spots, and the fragile illusion of stability that props up the financial system. Today, we'll uncover the hidden mechanics of Archegos' rise and catastrophic fall, revealing how one man's ambition and secrecy triggered billions in losses and forever changed how Wall Street views risk. To understand the fall of Archegos Capital, we first need to understand its founder, Bill Hwang. Once a rising star in the hedge fund world, Hwang was a protege of Julian Robertson, the legendary investor who founded Tiger Management. Under Robertson's guidance, Hwang became one of the Tiger Cubs, a group of elite fund managers who gained fame for their aggressive, high-performing strategies. In 2001, Hwang launched Tiger Asia Management, focusing on Asian markets. His fund quickly gained a reputation for strong returns. However, Hwang's career took a dramatic turn in 2012, when Tiger Asia was embroiled in insider trading charges. Hwang admitted to using non-public information to execute trades, resulting in an $18 million settlement with the U.S. Securities and Exchange Commission. After shutting down Tiger Asia, Hwang pivoted, creating Archegos Capital in 2013. Unlike hedge funds, Archegos Capital was structured as a family office, managing Hwang's personal wealth. This move wasn't just about starting fresh. It also meant Archegos would be exempt from many of the regulatory requirements imposed on traditional hedge funds. Free from strict oversight, Archegos quietly amassed billions of dollars in assets under management, setting the stage for one of the biggest financial implosions in history. Archegos operated with a simple but risky philosophy: bet big on a few stocks using massive leverage. Hwang believed in the long-term growth of companies like Viacom-CBS, Baidu, and Discovery, concentrating his portfolio on these key players. By leveraging total return swaps, Archegos could control large positions without directly owning the underlying shares, keeping its true exposure hidden from the public eye and even regulators. Total return swaps were the secret weapon behind Archegos' strategy. Here's how they work. Instead of buying a stock outright, Archegos entered into agreements with banks like Credit Suisse and Goldman Sachs. The banks would purchase the stock on Archegos' behalf, while Archegos paid a fee and received the returns as if it owned the shares. This allowed Hwang to take massive positions, worth billions, without disclosing them to regulators. It was a brilliant but dangerous strategy, one that would prove catastrophic when the tide turned. Archegos' strategy relied heavily on the cooperation of major banks. Institutions like Credit Suisse, Nomura, and Morgan Stanley provided the leverage that allowed Archegos to control tens of billions in notional exposure. Each bank assumed it was just one of a few lenders, unaware of the scale of Archegos' dealings across the financial system. This lack of communication and transparency between institutions created a ticking time bomb with billions of dollars at stake. By late 2020, cracks in Archegos' strategy were beginning to appear. Analysts questioned the inflated valuations of certain stocks Archegos had heavily invested in. Viacom CBS, for instance, experienced a dramatic surge in price despite no significant changes in its fundamentals. Behind the scenes, some compliance officers at banks raised concerns about Archegos' growing leverage. However, these warnings were largely ignored, as the profits from Archegos' trades continued to flow in. One of the key factors in Archegos' rise and eventual fall was its status as a family office. Unlike hedge funds, family offices are exempt from many disclosure requirements, allowing them to operate in relative secrecy. Archegos exploited this regulatory blind spot to quietly build massive, highly leveraged positions. Critics argue that this lack of oversight enabled Archegos to manipulate markets and put the financial system at risk. Archegos' rise coincided with a historic bull market, fueled by low interest rates and massive stimulus measures during the COVID-19 pandemic. Stocks were soaring, and banks were eager to extend credit to high-performing clients like Archegos. But what seemed like a winning formula was, in reality, a house of cards, vulnerable to even the slightest market downturn. By early 2021, Archegos controlled billions in stocks like Viacom CBS, whose price had been driven to unsustainable levels. The firm's high-leverage strategy left it dangerously exposed to market volatility. All it took was one bad bet to trigger a chain reaction, one that would ultimately bring Archegos and its lenders to their knees. At the core of Archegos Capital's strategy was its laser focus on a few key stocks, including Viacom CBS, Discovery, and Chinese tech companies like Baidu. These concentrated positions, often accounting for billions in exposure, were a double-edged sword. On one hand, they amplified gains as stock prices surged, but on the other, they left Archegos dangerously exposed to even minor market corrections. By aggressively purchasing shares through total return swaps, Archegos created artificial demand for these stocks, driving prices to unsustainable levels. This feedback loop gave the illusion of strength and stability, masking the underlying risks. Total return swaps allowed Archegos to control massive positions without ever directly owning shares. This financial tool, often used by hedge funds, transferred the risks and rewards of stock ownership to Archegos, while keeping the actual shares on the books of its partner banks. This not only obscured Archegos' exposure, but also allowed it to sidestep regulatory disclosures. For Archegos, this arrangement had another key advantage: leverage. By using borrowed money to finance its bets, Archegos could multiply its returns. However, this same leverage also magnified its losses, a risk Hwang seemed willing to take. Archegos didn't rely on just one bank. It partnered with multiple financial giants, each eager to extend credit to a lucrative client. This decentralized setup allowed Archegos to quietly amass over $100 billion in notional exposure, a figure far exceeding its actual assets under management. Worse, the banks didn't realize the scale of Archegos' total exposure across the financial system. Despite red flags, the banks prioritized short-term profits. Archegos was a high-value client, and no institution wanted to lose its business. This collective complacency allowed Archegos' risky strategy to continue unchecked. The price surges in Archegos portfolio stocks didn't just create financial gains, they also influenced market perception. Analysts and investors, unaware of manipulation, saw the rising prices as signs of strength, further fueling demand for these stocks. It was a self-perpetuating cycle, but one built on a shaky foundation. This wasn't the first time a financial bubble had been inflated by excessive speculation. But Archegos' use of hidden leverage made this bubble unique and far more dangerous. One of the most glaring issues in the scandal was its status as a family office. Unlike hedge funds, family offices managing personal wealth are not required to disclose their holdings to regulators. This lack of transparency allowed Archegos to quietly accumulate massive positions without raising alarms, even as it manipulated the market. By operating under the radar, Archegos exploited a regulatory loophole, effectively making itself invisible to the very watchdogs tasked with maintaining market integrity. As Archegos' exposure grew, so did the risks. By late 2020, some bank compliance officers began to voice concerns about Archegos' leverage and its reliance on a small number of stocks. But these warnings were drowned out by the promise of continued profits. Banks continued to extend credit, even as Archegos' strategy became increasingly unsustainable. The bubble finally burst in March 2021, when Viacom CBS announced a $3 billion stock offering. Investors reacted sharply, sending its stock price into freefall. This single event triggered a domino effect, exposing the fragile nature of Archegos' positions and setting the stage for its catastrophic collapse. As stock prices plummeted, Archegos faced margin calls it couldn't meet. The illusion of stability was shattered, and the house of cards came crashing down. Archegos Capital's collapse was a textbook example of modern market manipulation. By leveraging hidden positions and exploiting regulatory gaps, it created artificial demand, inflated prices, and ultimately destabilized the very markets it profited from. The question now is, what can be done to prevent this from happening again? The collapse of Archegos Capital began on March 2021, when Viacom CBS announced a $3 billion stock offering. While the move was meant to raise funds for the media giant's streaming ambitions, it sent shockwaves through the market. Investors saw the offering as a sign that the stock was overvalued, triggering a sharp sell-off. For Archegos, this was a nightmare scenario. The value of its highly leveraged positions in Viacom CBS plummeted, leaving the firm vulnerable to margin calls. And as one stock tumbled, the dominoes began to fall. Margin calls occur when an investor's account falls below the minimum required equity due to declining asset values. For Archegos, the sharp drop in Viacom CBS's stock price triggered immediate calls from its lenders to post additional collateral. But Archegos didn't have enough cash to meet these demands. Scrambled to meet these demands, the firm faced a liquidity crisis. Its lenders, now realizing the scale of exposure, began liquidating its positions to recover their loans. This fire sale further accelerated the collapse of the affected stocks. The forced liquidation of positions unleashed a chain reaction. Stocks like Discovery, Baidu, and Tencent Music, which had been propped up by Archegos' massive purchases, saw their prices crash. Billions of dollars in market value were wiped out in a matter of days for investors and traders. The sudden collapse of these stocks was shocking. Many were unaware of Archegos' role in inflating their prices, leaving them blindsided as the market unraveled. The banks that had enabled Archegos' strategy were hit hard. Credit Suisse reported $5.5 billion in losses. Nomura lost $2.9 billion, and others, like Morgan Stanley and Goldman Sachs, suffered significant hits. The scale of the losses raised questions about how these institutions had allowed such risk to accumulate unnoticed. The problem wasn't just Archegos, it was systemic. The banks had failed to communicate with one another, allowing Archegos to secure massive leverage across multiple institutions. Worse, risk management teams at these banks underestimated the potential for losses, leaving them unprepared when the collapse began. The collapse also exposed glaring regulatory failures. As a family office, Archegos was not required to disclose its holdings, allowing it to operate in secrecy. Regulators, like the SEC, were caught off guard, forced to play catch-up as the scandal unfolded. For many, the crisis was eerily reminiscent of past financial debacles, where unchecked leverage and regulatory blind spots led to catastrophic consequences. Calls for reform echoed across the financial world. On March 26th, Archegos Capital officially collapsed, unable to meet its obligations or recover from the massive sell-offs. The once secretive family office had become a symbol of financial excess, with its implosion leaving a trail of destruction in its wake. For Bill Hwang, the collapse marked the end of his career as a high-profile investor. While he avoided criminal charges initially, ongoing investigations into Archegos' practices hinted at deeper issues yet to be revealed. The Archegos debacle sent shockwaves through the financial system, prompting banks to reevaluate their risk management practices and regulators to revisit loopholes in disclosure rules. It also raised deeper questions about the fragility of modern markets and the role of leverage in driving volatility. The collapse of Archegos Capital was a stark reminder of the dangers of unchecked risk and the need for greater transparency in financial markets. Among the key takeaways, leverage must be managed. Excessive borrowing can amplify gains, but it also magnifies losses. Transparency is critical. Family offices and similar entities should be subject to stricter disclosure requirements. Stronger risk controls. Banks must prioritize robust risk management over short-term profits. The scandal was a financial reckoning, exposing vulnerabilities in our systems and forcing the industry to confront its blind spots. The collapse exposed just how fragile modern financial systems can be. In an era of high-frequency trading and complex financial instruments, a single entity's failure can ripple through the global economy, causing billions in losses and shaking investor confidence. It's a stark reminder of how leverage and opacity can amplify risks. For financial institutions, Archegos episode offers a sobering lesson: the importance of strong risk management. Banks must go beyond surface-level assessments and dig deeper into their clients' exposure, especially when leveraging opaque tools like total return swaps. Among the key takeaways: transparency across institutions. Banks need to improve communication and share critical information to avoid blind spots. Enhanced due diligence. Compliance teams must assess not only a client's creditworthiness, but also their overall market footprint. Limits on leverage. Establishing clear caps on leverage can prevent catastrophic losses. The scandal also highlighted regulatory blind spots, particularly for family offices. These private entities manage billions in assets, but are exempt from many reporting requirements. As a result, Archegos could quietly amass massive positions without raising red flags. To prevent future crises, regulators must mandate transparency. Family offices should disclose their holdings and leverage to avoid hidden risks. Enhance derivatives. Oversight. Instruments like total return swaps need stricter monitoring to ensure they're not being misused. Coordinate globally. Financial markets are interconnected, and regulators across countries must work together to close loopholes. For retail investors, Archegos serves as a warning about the dangers of market manipulation. When stocks skyrocket without clear justification, it's often a sign of speculative activity behind the scenes. Investors must dig deeper, questioning whether rising prices reflect true value or the actions of a hidden player. While the scandal caused significant damage, it also created an opportunity for growth and reform. By learning from these mistakes, we can rebuild a financial system that not only drives prosperity, but also safeguards against future crises. The scandal wasn't just a cautionary tale. It's a mirror reflecting the vulnerabilities in our financial systems. The next collapse may already be brewing. What do you think? Are current regulations enough to prevent another Archegos? Or are we doomed to repeat these mistakes? Let's discuss in the comments. If you're passionate about understanding the hidden truths of finance and uncovering the stories that shape our world, hit that subscribe button and join Cash Chronicles. Together, we'll explore the scandals, lessons, and opportunities that define the financial landscape. Don't miss what's next. Your next great insight is just a click away.